Welcome to this explainer. Today, we're unpacking a fascinating, honestly, almost cinematic breakdown of modern financial crime. We're going to look at the exact mechanics of how massive amounts of illicit, dirty cash get laundered globally, literally right under the noses of regulators. We're talking about a highly sophisticated value conversion system where physical commodities, false documentation, and totally legitimate financial institutions all become gears in this massive laundering machine.
Okay, let's dive into this with a scenario that, frankly, sounds like a thriller. How exactly does cash generated from, say, illegal cigarettes on the streets of southern Africa transform into perfectly legitimate-looking offshore wealth in places like the UAE or Switzerland? See, the operators of these illicit markets have a major integration problem. They're sitting on absolute mountains of physical cash, and they desperately need to place those funds into the global financial system without exposing the underlying crime. So how do they actually pull it off? Section 1. The Gold Mafia Exposé. The curtain on this specific type of operation got pulled back pretty dramatically back in 2023. An investigation by Al Jazeera titled Gold Mafia examined alleged financial networks spanning southern Africa, East Africa, the United Arab Emirates, and a few other major financial centers. One major focus here was an alleged South African network associated with a businessman named Mohammed Khan, often called Mo Dollars, and a Zimbabwean tobacco entrepreneur named Simon Rudland. The core allegation? That proceeds connected to illicit cigarette trading were being moved through South African financial institutions, specifically naming banks like Sasfin, ABSA, and Standard Bank. Now, I want to be crystal clear here. We are just analyzing the mechanics of these claims as a case study. These are strict allegations originating from undercover reporting. Simon Rudland explicitly denied the allegations, calling them a smear campaign, and the bank stated they'd investigate, fully cooperate with authorities, and take action if any actual misconduct was found. But as a structural model for how dirty money moves, this exposé is an absolute masterclass. Section 2. How false trade works. And this brilliantly illustrates the real engine of the operation, trade-based money laundering. Here's the exact pipeline they use to move that money. You start with step 1, the illicit cash. Now, to get that into the banking system, you need a cover story, right? Enter step 2, the fake invoice. The launderers create commercial documentation claiming they're importing goods, could be clothing, tobacco, or gold. Then, step 3, the bank processes a foreign exchange transfer to pay for this so-called import. And finally, step 4, the money arrives in an offshore account as a completely clean asset, supposedly just the revenue from legitimate commercial trade. The underlying goods, well, they either don't exist, never enter the country, or their value was wildly misrepresented. To really understand how hard this is to catch, I want you to put yourself in the shoes of a bank compliance officer for just a second. When you look at your computer screen, false trade and genuine trade look basically identical. The payment passes through the formal banking system, there's a known corporate customer, an offshore supplier, and a highly plausible commodity description on an official-looking invoice. Ask yourself, does this invoice match the market price? Do the goods actually exist? A bank only spots the criminal purpose if they actively test whether the underlying trade is real. And honestly, that's incredibly difficult when the paperwork itself looks absolutely pristine.
Section 3. Why launderers love gold.
Now, what's really interesting about this slide is that while fake invoices for, say, clothing might move a little bit of money, if you want to move staggering amounts of wealth, gold is the absolute perfect instrument for money laundering. It carries recognized value across borders, it's highly portable and divisible, bars, jewelry, scrap metal, you name it. Crucially, it can be melted down and recast, which completely wipes out its supply chain history. But the absolute biggest advantage? Physical gold can move entirely outside the banking system while simultaneously blurring the line between being a currency and being an asset. Once that illicit cash buys gold, the value is secured and ready to be resold literally anywhere in the world. Just think about the sheer scale for a second. The quote here really hits the nail on the head. A multi-million-dollar transfer may appear economically plausible, where the invoice concerns precious metal rather than low-value consumer goods. I mean, if a newly formed company suddenly wires $10 million offshore for t-shirts, massive alarms go off. But $10 million for gold? That's just a regular Tuesday in the commodities market. Gold provides the ultimate economic cover story for massive illicit wire transfers.
Section 4. The insider threat.
Even the absolute best fake invoices can sometimes trigger a bank's automated warning systems. And that's where the most critical vulnerability comes in. The Al Jazeera investigation highlighted allegations that banking personnel were actively compromised. And guys, this is a total game changer. An external threat, like a typical criminal, has to blindly guess how to work around a bank's procedures. But an internal threat? A corrupt employee uses their own legitimate permissions, their deep knowledge of the system, and their credibility to weaken the controls from the inside. A compliance employee knows the exact alert logic to bypass. An IT admin can literally alter audit records. The insider doesn't even need to control the whole bank. Just a few employees handling narrow functions can completely neutralize a bank's defenses.
So a really crucial point here is understanding how these insiders actually get compromised. It's rarely some dramatic briefcase full of unmarked bills handed over in a dark parking garage. The benefits are often surprisingly mundane. According to the reporting, bribes took the form of recurring holidays, property improvements, or just debt repayments. Sometimes the bribe doesn't even go directly to the employee, but maybe to a relative instead. This is exactly why banks have to heavily monitor for unexplained lifestyle changes or undisclosed outside business interests. A simple annual conflict of interest form just isn't going to cut it if an employee is actively hiding a relationship.
Section 5. The legal fallout. These exposés didn't just generate splashy headlines, they triggered a massive, real-world cascade of legal and regulatory consequences. Following the documentary, the South African Revenue Service, or SARS, issued a staggering 5.3 billion rand civil summons against Sasfin. SARS basically alleged the bank assisted taxpayers in unlawfully moving undeclared funds offshore. Now, Sasfin firmly disputed liability and challenged the legal basis of this claim in court, with the judge actually later upholding some of their objections while still allowing alternative claims to proceed. Internally, banks like Sasfin and Standard Bank initiated major forensic investigations, dismissed employees connected to the misconduct, and even pursued criminal complaints.
Looking at how this whole thing builds across the global stage is wild. After the 2023 investigation and that subsequent SARS summons, the international community stepped in. By December 2024, the United States and the UK imposed heavy sanctions on a network led by Kamlesh Patni for gold smuggling and money laundering. This immense pressure forced some very real systemic changes in South Africa, leading to major anti-money laundering reforms. Ultimately, by October 2025, the Financial Action Task Force, the FAT, officially removed South Africa from its increased monitoring list. Delisting was a massive institutional achievement, though. As we know, it certainly doesn't mean financial crime has vanished entirely.
Section 6. Stopping commodity laundering.
So if conventional controls are missing the mark, what does a resilient defense actually look like? Well, the solution requires what experts call a resilient control stack. It means moving way beyond just checking if an invoice exists. You have to actually verify the trade data against live market prices and real customs shipping records. It requires incredibly strict privileged access controls to stop rogue employees from just overriding the systems. But most importantly, it requires network-based transaction monitoring and cross-functional investigations. The AML team, the fraud team, the tax team, they simply can't be siloed anymore. They have to connect all this fragmented, messy data into one cohesive economic narrative so they can see the true picture. Because at the end of the day, this isn't just a banking problem. When billions of dollars are funneled through dark channels, it hollows out tax bases, starves public services, and completely warps the everyday economies that all of us rely on.
The absolute greatest risk arises when every single component, the registered company, the bank account, the invoice, the commodity, looks perfectly legitimate in isolation. Which leaves us with a critical lingering thought to wrap up on. When millions of dollars are moving across borders and every single piece of paperwork is stamped, signed, and looks utterly flawless, who is really checking the gold? Thanks for joining me on this explainer. We'll see you next time.